There we go. Jesus. Yeah.
Welcome everyone to Name Confidential Live.
Hey everyone, thanks for bearing with us a couple minutes through some technical difficulties getting stuff rolling today. Uh, anyways, today we're pleased to have Matt. And Matt, I am going to say your last name wrong, so help me on this.
Markiewicz.
Markiewicz.
Yeah, definitely. Little, unless your Polish is up to snuff, it could be a tough one.
I even tried practicing. Anyways, so hey, we just wrapped up another week in the markets. Name exposure index currently coming in at 79.13. Last quarter's average was 80.82. So right around this average exposure from our sentiment survey across the organization for active managers. Just an interesting data point. We have an election coming up, and there's all this stuff going on. And as much as I love to talk about all that stuff, I think we're going to have a little bit of a different conversation today, talking about maybe some of the ways people should consider using different tools as they navigate these markets. Anyway, so Matt, why don't you introduce yourself a little bit? Tell us who you are and what you've done throughout your career that's kind of brought you to where you're at, and then we'll hop into a discussion today.
Sure. Hey, everybody. Really nice to be here. Thank you. My name is Matt Markiewicz, and I am the head of product and capital markets at a firm called Trdr ETFs. I've been on Wall Street for 27 years, sales, trading, research roles. And for the past 15 years, I've been in the wonderful world of ETFs, having spent almost 7 years at BlackRock and launching 150 products there as part of the capital markets team. I went off on my own in 2017 and launched some funds that kind of, I'd never would have been able to launch at BlackRock, namely more thematic funds as well as some derivatives-based funds. And that's kind of what brought me to here. At Trdr, we have 16 leverage and inverse ETFs. Including 12 of those 16 are the first to ever offer a non-daily performance reset. So that might be an odd term for a lot of you, but you're probably familiar with leverage ETFs, quite actually, from speaking to a lot of name members over the past couple months. But there is one common thread through all 200 leverage ETFs that have been in existence for the 18 past years, and that's that they've reset their performance daily. So when you see a XX fund getting 2X or 3X, you're only getting that leverage for a day. And what we did is we came up with a solution that resets at a longer interval.
I think so. The conversation to be had, I think sometimes is about using leverage, especially from a portfolio management standpoint as active managers. How do you deploy leverage, or why do you deploy leverage? Throughout your career, what have you seen the primary reasons being that people are deploying leverage, and what's the ways that people have historically accessed that before you could use leverage funds, or before that was a little bit more mainstream?
Yeah, obviously right now, you can use options, which are, can be quite confusing sometimes. And, the pricing can be all over the map, especially in esoteric asset classes, or asset classes where there might not be a lot of options volume. There could be, you can use leverage by borrowing from your platform, right, which is expensive. And then you have to kind of deal with the vagaries of the market movement and margin calls. So from a management perspective, that gets to be a little bit trickier unless you have a bigger team, right, Brandon? That's kind of on top of what's going on in your margin account all the time. And there have been a couple leverage mutual funds, that have been in existence for a while, Guggenheim, Ridex, and the like, that sort of we've brought a very similar flavor to the market, but just in the ETF world. So at the end of the day, leverage is just a way to use capital more efficiently. And as we've seen from an active standpoint, it's been, very hard to beat a benchmark over the past 10, 15 years, which is why you've seen the rise of index products, being used in active strategies, right? To get that beta exposure as you're looking for alpha. And, when you're using capital more efficiently with leverage, it's a much easier way to kind of beat that benchmark, as opposed to just trying to, selection, right? Being in the right asset class, being in the right stock, even harder. And, when you have more tools at your disposal, we've had the conversations that, I think I've been surprised how many RIAs and advisors are using leverage around the edges, just because it's a world that I've never lived in, but, it is being used and used effectively.
Yeah. So when funds first started having, when there's first rise, which, the kind of the original opportunity in a fund was the mutual funds. Like you mentioned, the RIDEX funds have been around for a long time. That family of funds. How does a fund go about internally building a fund so that the leverage is available, right? Like how does not your funds specifically, but just as a general idea, right? So I go and buy $100 worth of fund or put $100 into a fund. What does a fund manager then do to get the exposure, the leverage exposure that the investor is looking for, that the fund's purpose is?
Yeah, a few of those ways that you can achieve the leverage as I mentioned with options, right? And you can use options to get the return profile that you're looking for. Again, could be tricky from a pricing standpoint. Then you have to roll the contracts, of course. You can use futures, also a capital efficient way, but futures are not available for most of the exposures out there, right? You don't really have gold miner futures, as far as I know, right? You might have gold futures, but not gold miner futures, where there is an ETF, for that kind of exposure. You could use, as I said, options. You could use futures. You could use a mix of some stocks and options. But the way that most leverage funds these days get that exposure is through total return swaps. And those are with, you have a contract with the bank or with a bank or a counterparty that will guarantee them delivering some type of exposure over a certain period of time, to the fund. So when you invest in a leverage fund, you have that fund provider that's essentially making it easier to access that leverage. Again, you could do this on your own, but it becomes a little bit cumbersome, especially across hundreds or thousands of accounts, right? So the total return swap that we use for all our products, it's a 13-month bullet swap, so it has some tax advantages there because you're kind of getting past the 12 months. And we're only posting a certain amount of funding collateral, so we're earning money on the cash that's sitting there, which is also an advantage. We don't have to be fully invested, and there's an income component to investing in the fund as well. Or say the fund kicks off interest income, which helps to offset some of the expenses at the end of the day.
Okay. So I think something that a lot of either managers or allocators in the industry might be confused about is these types of ideas under the hood. What does that cost look like to access this stuff, right? Because it's easy to look at it and say, well, that an expense ratio is 1 or 2% or something, right? And on its face, if you looked at that and somebody told me, hey, you can get 2 times leverage for 1% a year, well, that would make a ton of that would make too much sense. It'd be like free money. If where interest rates in a risk-free environment are 4 or 5%, right? There would be a ton of just structural alpha. It'd be almost a no-brainer. And so one of the things that I had learned is that there's additional costs, right? So explain to me how maybe that works a little bit in these funds and what people should be aware of when they look at what the total return is in the fund over the period that it's aimed to align the leverage with.
Yeah, so on the long side of the equation, when a fund has a long exposure, they're paying a financing charge to finance those swaps. And for inverse funds or short funds, you're actually getting paid to hold those exposures. Plus, as I said, on both sides, you're earning cash on the collateral. So while, an interest rate environment like we have now, Brandon, with, let's call it low fours, mid fours, depending where we are, right? You're actually getting a healthy amount of cash, interest on that cash in the fund, even on the long side. So it kind of helps to defray some of that swap financing cost. On the inverse, of course, you can really generate a nice, healthy amount of yield. And that sort of, that trade, that structural alpha that you were talking about, there are a lot of funds that actually, especially on the hedge fund side, that do try to take advantage, right, of that arbitrage, going long the 2 times whatever, and going short the similar exposure, right? Or conversely, depending where rates are on the opposite side. On the short side, you do have to factor in there is a cost to actually borrow that underlying set of equities or security. By and large, though, that is a very inexpensive thing to do because the cost to borrow, let's say you're in a short SPY fund, the cost to borrow SPY is a lot cheaper than saying borrowing MicroStrategy stock, right? MSTR, which is a long short seller's delight, up and back and forth. There's a higher cost to that asset because it's much smaller, it's more volatile. So the institutions that are lending you those securities will charge you more for it, right? It's not what they call general collateral, which is base rate for easy to borrow securities. Certain things that have a much higher borrow cost that could definitely impact the ultimate NAV performance of the fund. But again, like you sort of you said, what should people consider? Remember the performance that you see for ETFs in particular, maybe not during the day, but the NAV at the end of the day, that includes fees. So that's all coming out on a daily basis, right? So you have this borrowing cost. Let's say it costs you 4% to finance the swap over the course of a year. You're only paying 1/365th of that every single day, right? So we get a lot of advisors say, "Oh, I see your expense ratios is 1.3, and it could be higher." If depending on the financing costs. And I said, listen, yeah, it's definitely, it's possible, right? But you're also generally not holding your positions that long, right? From an annualized basis. In addition, it's still cheaper than if you were to do it yourself, right? So we're bringing an institutional wrapper whereby we can have what's called an ISDA with various banks, right? And they're not going to give that type of credit to an advisor that has even $1 billion, for instance. So, it's a trade-off, just like everything else.
So why does an ISDA matter? Why should somebody care about that if they're, allocating assets out?
Yeah. So an ISDA, again, is a contractual, is a contract that you sign with a bank that is, for instance, we have an umbrella ISDA with Goldman Sachs that includes all of our funds. Right. And then they are willing to offer balance to provide swap exposure for our funds. And that is the process. It's not like just going down to the bank and opening up a checking account. I mean, it's a pretty thorough background check. There's a lot of documentation that's needed. They have to know that you have assets of a certain size in the organization as a whole, not just necessarily in that fund, and that your processes, Brandon, to running that fund are up to their competencies. And they want to make sure that you're trading, like especially for a leverage fund, that you're hitting your leverage levels and re-levering to the appropriate levels every single day. We've gotten in trouble in this country and this financial system way too many times with incorrect use of leverage, and getting leverage through a bank has been much harder since the financial crisis. Because of course that's almost what brought down our entire financial system, right? It was the overuse of leverage, this time on the housing side, right? In the financial crisis. And we've had a bunch of scares, namely the most recent one, Archegos, right? Which was over levered with a bunch of different brokers, and each broker didn't know what each other broker had. And it just kind of like, there was this death spiral. Mutual funds, ETFs, every day how much swap exposure we have to each counterparty, right? It's completely transparent.
Is that so the ISDA agreement is a contractual obligation then between you and the counterparty, or, you know, a fund and the counterparty, so to speak,
Yep.
right?
Mhm.
So I mean, that's all important stuff. So when somebody goes to look and utilize a fund like this from a portfolio standpoint, why, like, where does that fit in an allocator scenario, right? So if a portfolio manager is trading a strategy, they have, let's say, like a long short, and they want to deploy leverage, you know, that's usually pretty easy to identify, the use case there. What if somebody just says, hey, I have more of a traditional portfolio, or, you know, I have kind of that 60-40 portfolio traditional allocation. Like, where does leverage funds of, you know, what any variety start to fit into the picture that people should be thinking about or considering? What are some of the advantages that people can look for there?
Yeah. So let's take your 60-40 example.
Mhm.
You know, of that 60 that's in equities,
Mm-hmm.
the majority of that is going to be in US equities, most likely, right? Maybe you have a little EM, you have some developed market ex-US around the edges, you know, whether it be in a mutual fund or ETFs. So what you could do in that case, let's just say you had $100 and 60 of it was in equities. You could take a portion of that 60, and let's just say it's half, 30, and you could get, with a 2 times S&P 500 ETF, you could get $60 of exposure with only using half the money.
Sure.
And then what you would do is you would take the other 30 and then either allocate it more to fixed income, or maybe a minimum vol strategy on the on the equity side, something that has a bit of a floor, right? Or a higher yielding instrument, so that you're collecting some yield from that money that, you know, you're not using on the equities. But again, you're using only 30 to get 60 of exposure, right? And that's where leverage becomes so powerful, especially over the longer term as things compound. It's definitely a tool we feel is probably being underutilized overall, because a lot of advisors and funds are just not able to use either leverage straight up or leverage funds in their account. But again, that's the most simplistic, taking half your equity exposure,
Okay.
putting it in a leverage fund. And then, you know, on the fixed income side, same thing. We have 2 leverage fixed income funds at the long end of the curve, right? And you could do the same thing. Of that 40%, take $10, get twice the exposure.
So yeah, let's talk about that for a second. So if you have leverage exposure on a bond and on a bond fund, and the yield curve's been inverted, I mean, I'm going to kind of take the other side of this equation here, right? And like sort of poke a hole. If cash rates or risk-free rates have been, let's call it 5, and, you know, the yield curve's inverted, so the long end is down at, we'll call it 4.5 or something, right? Like it is inverted, and you're going to have to pay the cash rate as a financing charge to have that swap in place internally in the fund, to have, right, that total return swap. Isn't that going to chew up then the yield that you would be receiving on the bond fund otherwise? And so you're only getting the a leverage movement in the price of the bonds, not really collecting the yield. Is that?
Yeah, I think it's a fair, you know, in a simplistic way. Yes. You know, the 4% you're getting on TLT, which is not even that high, but, you know, let's say that's what our fixed income exposure is on the long end of the curve. You know, I don't think our financing cost is, you know, going to be quite that high on that one, because it's not a volatile instrument, so it's a little bit lower to finance something like that with less volatility. But you are going to be getting, like you said, we will have access to the price a little bit, you know, and the long end of the curve is the more volatile end, right? So if you think that, you know, long end yields have, you know, a higher probability of falling, the price sensitivity for longer, you know, for like a TLT type instrument, it's a lot more sensitive, right? So you would, in that case, you know, you just look at you can look at the levered funds and that are, you know, on the long end of the curve now, the you know, the daily funds, they exhibit quite a bit of volatility. They don't just kind of move like this because they're so rate sensitive. And you know, we saw, you know, back in, was it March, April, we saw kind of a a little rally in the long end in terms from a price perspective as yields kind of went down. As you said, there was then further inversion, and now kind of we've seen weakness the past month and a half or so, 2 months at the long end. So again, it really just depends on your view, and that's why I don't think, quite frankly, we would ever launch something, a levered version at the short end of the curve, right? Because as you mentioned, like generally the rates are not going to be there. Your yield's not going to be there to support the financing that you're going to pay, and you're going to have little movement in the short end. You're not going to have a 2x levered 6-month T-bill ETF. That would make a ton of sense. People play the long end for the vol and for the principal appreciation.
So it's definitely a trading instrument there, right? If you're going to trade the volatility, it sounds like. Going back to the kind of split, right? If you take a traditional asset allocation, cut it in half, but use 2-time leverage fund, what separates you? I guess what you're kind of how do I want to say this? To highlight what I think you were saying is, if you are going to deploy the that half of capital that now is no longer invested in direct long exposure, it has to be some type of risk asset still, right? Because if you go with like something more risk-free, it's going to just really kind of offset maybe the cost internally in the fund that somebody doesn't necessarily see in an expense ratio for those financing charges on the underlying swaps, right? So correct me if I'm wrong here, but in a leverage fund, if somebody essentially, if you had a 2 times leverage fund, you took the half of the portfolio, or that allocation that you don't need to allocate to the equity side anymore in this scenario, and you put it in T-bills or money market or something, right? You're going to end up with just the same performance, basically total performance of just an index fund, but it's going to have obviously then a higher expense ratio because you paid somebody to manage the leveraging of this other fund in this scenario, right?
Not really, because remember, there's no other way you're going to get that return on that small amount of capital, right? Because you're getting more exposure. So I see what you're saying. You're like, on that stub that you're not investing, physically in equities. Kind of the dilemma is what do you do there, right? Where do you put it, right? But the management fee that you're paying for, the leverage strategy, assuming you think things are going to go up, which is kind of why you would invest in it, unless you were short, which is an option, then it might be just as good to go to cash, is going to be outweighed by not necessarily, like putting in like a dividend yielding fund, right? Something like that, where you take that, there's a high dividend, physical, you're receiving income from it, right? So like a DVY or a VIG or some VYF, whatever Vanguard has, something like that, right? And you're collecting, some yield there. You still have some exposure, and you can kind of, if equities you start appreciating, you get to capture that, that move in the actual stock price itself, as well as receiving the income. So wouldn't necessarily put it in something that's quote unquote risk-free, right? That other 30% of the 60. You'd want a little risk there to kind of capture the upside. Maybe not put it in a direct fixed income, investment. That's or you could put it in an equity, like, with more risk, like a high yield fund, right? That you're getting 7-8% coupon, even higher if you go down to CCC funds these days. And then you of course have a lot more volatility, but it's more like inequity, like return profile and risk profile. The further in credit quality you get down.
Yeah. I think the thing that jumps out to me is that there's some really interesting use case for these type of funds. There's a number of scenarios in which an allocator or a portfolio manager may consider the deployment of these funds. But there's also a significant amount of risk and volatility that needs to be measured and understood. And so obviously, like this being a live stream podcast, I have no idea who is listening or what. So I want to remind everyone, like, if you're not a professional and you don't understand these things in depth, don't run out and just start buying leverage funds, right? There's a lot to it. Engage with a professional and seek some professional help and advice. But that being said, I appreciate the work that not just you guys, but all the fund providers or people out there that have developed these type of things, because they are, I think, useful tools that people can consider, especially allocators, when they're looking to help people achieve their investment goals. So, Matt, I know your time's precious. I appreciate you hopping on today.
Definitely.
And keep fighting the good fight out here, I guess.
Appreciate it. Thanks for having me on, and thanks to the NAAIM organization, looking to get more involved. And again, everyone have a great day.
Yeah, I look forward to seeing all my NAAIM friends down in Dallas, on Sunday, with the conference being Monday, Tuesday next week for NAAIM Outlook, and that's always one of my favorite conferences of the entire year. So, anyways, we'll see you around, Matt. Take care.
Thanks again.